and related then to legal agreements. Legal agreements really, when you're reviewing them, you're looking out for the risks and things that might go wrong in the business. I mean, you could have things that may be upside from those reviews, but it's all part of a wider just understanding the risk associated with the investment you're going to make. The point of due diligence is to understand these risks and be able to mitigate them or price them in, so that when you're asking for a stake in the business or when you're structuring your investment, you know how to deal with the risk. For example, if you're not sure about tax returns and obligations the business may impose upon you, you may opt not to invest as equity, but opt to invest as debt to the business, because the relationship there is different. But that's all ways of managing risk. So the aspects of risk you look to manage under the product, you want proof that the business will be able to execute on their roadmap. Under operations, you want proof, or you want to see that the business can execute on their operational model. They are able to turn around output to customers quickly. When things break, they fix them quickly, and you want to be able to assess that. In terms of sales, you'll have looked at how long it takes for them to onboard a customer, how they serve the customer, and whether they can do that repeatedly and grow. So you're assessing that. For marketing, remember, you looked at how long it takes for the business to acquire a customer. So are there opportunities to lower this? Are there risks that this may increase as the business scales? So you're scrutinizing for that for the business. On the management side, it's important that the business is self-aware and knows where there are gaps and where they need to be filled and what key hires they'll need, because this plays into the financing risk and how much capital the business needs to raise. Just check, you want to be checking that risk, and you want to be checking as well, because the CEO can present a key man risk. So one, are they in good health? Are they the person to lead this business, even in the next phases of growth it's going to experience? Because it is common when the business grows later for the CEO to be replaced. But is that the kind of CEO that will accept or will understand that they need to be replaced? Or are they the kind of CEO that is coachable and grows with the role as they grow as a business? You then want to be looking at the financial risk as well associated with the business. Generally, is there any debt that could be forced to convert and maybe dilute you as if you're investing as equity? Or is there a risk that the business will not be able to pay that debt, or the cost of that debt burden the kind of profitability the business is making? So do you need to restructure it? What was the valuation the last time the business raised money? Was it a down round? Was it too high? So it gives you an indication of what's going to happen in the future, in as far as being able to raise more financing at realistic pricing without you as an investor suffering a down round. Yes. And related to then the valuation is the terms for investing into the business, whether they are too high or too low. And the business does not operate in a vacuum. So you want to look at where you are in the economic cycle. Some of and similar to, I guess, the US, the UK, any other parts of the world, there will be an election cycle, and this affects businesses more so in some of the democracies that are young on the African continent. There's economic cycles that revolve around elections, and economies get contracted and depressed in election years. So that should play into your timing or how you're investing the business and reflected in the pricing, and how is the business mitigating this? One way to mitigate it is to scale across countries, so that when it's elections in one country, it's not elections in another, and you're still making money. And you just want to look and see where's the economy cycle now? Are you recession or recovery? Is the business exposed to that recession or recovery? Are they poised to gain from it? Or are you taking a bet that when there's a recovery, if it's a recession, when the economy recovers, they'll do well, and therefore you price in that risk? And of course, there'll be events like the current COVID-19 pandemic, which were hard to predict, and they have effects on businesses. So the risks could go on beyond this. And you just need to just be aware, because this is a checklist of them. But in doing the due diligence and looking at the documents and asking the questions, hopefully by the time you come to assessing the risk, you get a good handle on how to quantify it, and whether you're comfortable with it or not, whether you're comfortable with the ways this risk will be mitigated by the entrepreneur or the business. Which brings us back to our red flags and reasons. Remember at the start, I told you, when you do due diligence, you're looking for a reason not to invest, and the business should convince you otherwise. So some of the red flags, which relate to some of the things we talked about last week. If there are management team issues, for example, you can't get 2 or 3 co-founders that are full-time. The team struggles to hire good talent. There are lawsuits. Some of these, you just walk away. A crazy cap table, maybe too many people on the cap table, previous valuations that are too high. If there's excessive debt, it means the business will be drowning in that debt. So if there is excessive pre-existing agreements, for example, non-competes, because this has implications for morale, and has implications for what else you may be able to do after you've been involved with that particular business. The nature of the shareholders. I know of a business that had a shareholder who was quite cumbersome, and he was threatening to sue the company and disrupt funding rounds for successive investors. The story really was that this business had been incorporated in one country, and because they were now growing and scaling across the continent, the sensible thing to do was to move all shareholders into a holdco in a favorable jurisdiction, and that holding company would own 100% in subsidiaries on the African continent. But this particular shareholder was refusing to move because he wasn't happy with the valuation he was getting in the holdco, and this was just creating problems within the business, in as far as bringing on board other shareholders was concerned. And it then came down to the tag along, drag along clause within the company, and how well this had been written. So because that hadn't been written appropriately, this shareholder was then causing trouble for everyone else, and they were a minority shareholder. So you just have to be careful as you get into these agreements, or if you're looking at due diligence before you invest in this business. And then how quickly businesses give you due diligence information also gives you an idea of how they are organized internally, how prepared they are for this as well. If they're taking forever to provide information, then something fishy must be happening. And this is why usually when we work with businesses, we make sure we have a data room ready, that so that by the time an investor expresses interest, information at least is available to start to assess the business and be able to quickly say yes or no to an investment decision. Related to due diligence information not being promptly provided, if there are gaps in any information. While there might not be red flags, if there's a lot of yellow flags, then it's another reason not to invest as well. And this includes things like revenue. If you don't see that upward tick, capital that's excessive, that can't be explained by numbers, usually there's something fishy that may be happening. And it may point to integrity, or it may point to wastefulness in the entrepreneur. So and this is a discussion I usually have with some of the entrepreneurs I mentor around, are you delivering the most, it may be most impact per unit of capital delivered given to you, or the most growth in value per unit of capital. So when investment capital comes, and I always tell the entrepreneurs that focus on the value you're creating with that capital. So you want to be backing entrepreneurs that are efficient with capital. Complicated financial models that are just, you don't understand quickly how they make money, how they monitor their costs, and therefore what gross margins are, then that is a worry. If there is no business plan that is guiding growth for the company, and related to that, then all these factors usually means the story may not add up. The market they're targeting is not sufficiently large. The way they're going about it is probably not the right way. You can't have validation from the customers they already have to prove that they'll pay for their product, but somehow they are making some revenue, so it looks like lack. So you start to, if these are some of the yellow flags you see, then you have, it's more a no than more a no than yes to invest in that business. Yeah, so after you've done all this, you ask yourself the question again, why should I not make this investment? Should I pass? And I guess if the answer is most of the evidence is a high probability of why you should make this investment, or a yes, then you can proceed to write. You can proceed to write them a term sheet or start to consider terms. But that will be a session for down the road. So yeah, I guess it's a lot to try and do. Granted, a lot of what we've shared here is what, for example, if I had my hat on as an institutional investor at the 97 fund, this is what I'd absolutely be doing. And the summary of these checks would go to my investment committee before we go ahead to make a decision. When you're working together as an angel group, you're able to do a lot of this because you can parcel out the tasks. When you're working as an individual angel investor, it may be hard to do all of this. Where I've invested as an individual angel, personally, I get in very, very early. Then I get a chance to shape a lot of the things I've been talking about now. For example, where the company incorporates, the kind of structure they use, defining the business model and helping them prove product market fit with their initial customers. So I then am not checking a lot of these things. But if you're a group of angels, then you can parcel this out, because some of you may be good at legal, some of you may be good at operational products, some may be good at scrutinizing the team, and then you can each work on a little aspect of the due diligence, and then you bring it all together to guide your investment decisions. As an institutional investor, of course, you have to do all that. I think yeah, that has brought us to the end, but I think it gives us some time to be able to answer any questions. And I think while we were presenting, some questions were coming through and some comments.
Yeah.
So please feel free to unmute and answer or type them in the chat.
Thanks so much, Kenneth. There was a question that's buried way in the beginning of the chat that I thought would be good for you to speak to. When you were talking about sort of pairing the problem and solution and understanding if they pair, and the kind of sector expertise or market expertise that would be required to have that understanding. James was saying, what if the investor doesn't have that? I was wondering your thoughts on, especially investors that are based in the US who are looking at a variety, or the UK, or anywhere else outside of Africa, who have a variety of interests in different sectors, like how they can best go about assessing these business plans.
Yes, I do know a lot. Some of the angels I've seen who've done some deals fast, they go and invest in the areas they know. So I guess that sort of starts to solve that problem. That's one way. You could just focus in areas you know, or it might be a steep learning curve where you're going to have to learn about these industries to get that problem solution fit, or you come on a journey and get educated by the entrepreneur. And entrepreneurs can be patient and provide this information to help you learn. I do know, for example, right now, for some of the angel investors we've seen come on board, it's been a journey of 1-2 years before they invest. And that time they've taken time to just understand each of these businesses. So there's really different ways you can go about it. But as you responded, Rachel, as well, when you're part of a network, you may be working with investors who understand this area, or you may be co-investing with others who've done the diligence. And granted, they may charge you a bit for the diligence and the review they've done, but you can work with them if they have expertise in that area. But the first one is just trying to immerse yourself, or investing fast in areas where you know you have some kind of expertise. Otherwise, you then have to rely on other angels you're investing with.